Stop right now. Pull up the silver price on your phone or your computer screen. Whatever reliable feed you're checking, Kitco, Bloomberg, TradingView, the official COMEX ticker, it's almost certainly showing a number somewhere in the low to mid-70s, perhaps $73 or $74 an ounce as we begin 2026. That is the paper spot price, the single figure that the entire financial media ecosystem, from CNBC to Wall Street trading desks, treats as the undisputed global benchmark for silver's value. It is the price algorithms trade on, the price ETFs track, the price most retirement accounts and mining company hedges are tied to. But what if I told you that number is becoming dangerously detached from what is actually happening in the real world? What if, at this very moment on the ground in Tokyo, verifiable physical silver bars and coins, the tangible, weigh-in-your-hand kind that has served as a final store of wealth through every major currency devaluation and financial panic in recorded history, are routinely changing hands at prices equivalent to $128, $130, sometimes $135 per ounce or more. That represents an 80% premium, and in some cases even higher, over the paper price you see quoted everywhere else. 80% not a small dealing spread, not a brief dislocation, a historic chasm. Welcome to Cash Historian, where we go beyond the headlines to uncover the hidden history of money, dissect the mechanics of exploding global debt, reveal the closely guarded operating secrets of central banking, and grapple with the economic paradoxes that shape the world we live in while most people remain completely unaware. Today, we are examining one of the clearest and most alarming warning signals emerging in global markets right now in January 2026. The extraordinary 80% premium shock that has gripped Japan while the COMEX price lingers in the 70s. And why the enormous concentrated short positions held by major bullion banks, positions that have helped cap silver rallies for decades, are finally facing pressures that no amount of sophisticated financial engineering can fully neutralize or hide. Let that enormous gap really register. In a truly integrated, efficient global market, spreads of this magnitude simply should not persist. Smart money would immediately spot the opportunity, buy large quantities of silver at the discounted COMEX price, arrange delivery, cover shipping and refining costs, pay whatever import duties apply, and sell into the desperate Asian demand for a locked-in profit of $30 to $40 per ounce or more. Scale that up across millions of ounces, and the arbitrage profits would run into the billions, exactly the kind of risk-free trade that institutions live for. Yet the gap is not closing. In many reports, it is holding steady or even widening. This is not ordinary market friction. This is evidence of deep structural strain, the kind that only appears when long-standing mechanisms start to break down. And to fully grasp why this is unfolding right now, we need to follow the thread back through more than a century of deliberate choices, power struggles, and quiet redesigns of the monetary system. Silver's role as money is older than almost any other institution we take for granted today. The very first metallic coins ever minted in the Kingdom of Lydia in Asia Minor around 600 BC were made of electrum, a natural alloy of gold and silver. Ancient Greece, Persia, and Rome all built vast empires on silver coinage. The Roman denarius was the reserve currency of its day for centuries, until repeated debastements reduced its silver content and helped fuel the inflation that weakened the empire from within. In medieval Europe, silver thalers and pieces of 8 circulated across continents, backing trade routes that spanned the globe. When the United States was born, the founders were crystal clear about sound money. Article 1, Section 10 of the Constitution explicitly states that no state shall make anything but gold and silver coin a tender in payment of debts. The Coinage Act of 1792 defined the dollar as a precise weight of silver, 371.25 grains of pure silver, and established a bimetallic standard with a 15.1 ratio to gold. That system was not perfect, but it imposed real discipline. Governments and banks could not create unlimited currency without acquiring actual metal. Yet powerful interests always preferred greater flexibility. In the decades after the Civil War, as massive new silver discoveries in the American West, places like the Comstock Lode in Nevada, flooded the market with supply, Eastern banking elites pushed to shift fully to a gold standard. In 1873, Congress passed the Coinage Act that effectively demonetized silver, an event that Western miners and populists angrily dubbed the crime of 1873. William Jennings Bryan made it the centerpiece of his 1896 presidential campaign with his famous Cross of Gold speech, warning that abandoning silver would crucify ordinary working people on a cross of gold controlled by Eastern financiers. Bryan lost. The Gold Standard Act of 1900 cemented gold's dominance, and the stage was set for the next major transformation. That transformation arrived in 1913 with the creation of the Federal Reserve. A small group of influential bankers and politicians met in secret on Jekyll Island off the coast of Georgia in 1910 to draft the legislation. Figures like Senator Nelson Aldrich, Paul Warburg of Kuhn, Loeb and Copers, and representatives of J.P. Morgan's interests designed a central bank that would give private institutions extraordinary control over money creation while the dollar remained theoretically tied to gold. World War I shattered the remaining constraints of the classical gold standard as countries suspended convertibility to fund massive war debts. The interwar period brought instability, culminating in the Great Depression. In 1933 and 1934, President Roosevelt issued Executive Order 6102 confiscating privately held gold, devalued the dollar against gold by 69%, and passed the Silver Purchase Act to buy large quantities of silver at artificially high prices, partly to aid Western mining states, partly to engineer monetary expansion. By the 1950s and 1960s, persistent U.S. budget deficits and overseas military spending drained gold reserves. In 1965, silver was quietly removed from circulating U.S. dimes and quarters, replaced with copper-nickel-clad substitutes. The final break came on August 15, 1971, when President Nixon suspended dollar convertibility into gold for foreign central banks, effectively ending the Bretton Woods system. The era of pure fiat currency, money created without hard backing, had arrived. Inflation soared through the 1970s, eroding savings and punishing wage earners. Into this chaos stepped Nelson Bunker Hunt and William Herbert Hunt, billionaire brothers from Texas who had made fortunes in oil. Convinced the dollar was in terminal decline, they began accumulating massive physical silver positions starting in the early 1970s. They bought futures contracts on the COMEX, took delivery wherever possible, and stockpiled hundreds of millions of ounces in vaults. By late 1979, the Hunts and allied Arab investors controlled an estimated 200 million ounces, roughly two-thirds of annual global mine production at the time. The price exploded from under $6 in 1978 to over $50 an ounce in January 1980. For a brief moment, it appeared physical demand might finally overwhelm the ability of paper markets to dictate price. Then came the coordinated counterattack. On January 7, 1980, the COMEX abruptly changed its rules, imposing liquidation-only orders for certain positions, meaning holders could only sell, not buy new contracts to roll positions. Margin requirements were hiked repeatedly. On March 27, 1980, Silver Thursday, the price collapsed more than 50% in a single day as margin calls forced the Hunts to liquidate. The brothers eventually declared bankruptcy, owing billions. Regulators and exchanges had rewritten the rules mid-game to protect the system. The unmistakable message to anyone watching: physical corners can be broken if they threaten the financial establishment. That episode cemented a new era of managed suppression. Major bullion banks, J.P. Morgan, HSBC, Citibank, Scotia Makata, and others, built and maintained enormous concentrated net short positions in COMEX silver futures, often exceeding 200 to 300 million ounces, far larger than annual global mining output. Independent analysts like Ted Butler spent decades documenting how these positions consistently appeared to cap rallies and drive prices lower at key moments. In the 2010s, multiple investigations and lawsuits exposed outright manipulation. J.P. Morgan traders were caught placing thousands of spoof orders, fake buys or sells intended to deceive the market, resulting in nearly $1 billion in fines, penalties, and restitution between 2019 and 2021. Former CFTC Commissioner Bart Chilton publicly stated on record that silver markets had been manipulated for years. Yet the concentrated shorts persisted because suppressed prices served powerful interests. Low silver kept costs down for industrial users in electronics, photography, and later solar panels, while discouraging ordinary citizens from abandoning fiat currency during waves of quantitative easing. And those waves have been monumental. The Federal Reserve's balance sheet grew from under $1 trillion before 2008 to nearly $9 trillion after the COVID response. U.S. national debt now stands above $36 trillion, more than 120% of GDP, with annual interest payments alone approaching $1 trillion, eclipsing defense spending. Debt ceiling battles in Congress have become routine political theater because actual default is unthinkable. In Canada, the situation mirrors much of the same trajectory. Federal debt has more than doubled in the past decade, surpassing 100% of GDP when provincial obligations are included. Housing markets in Toronto, Vancouver, Calgary, and Montreal have become among the most overvalued in the world. Average detached home prices in Greater Toronto exceeding $1.5 million CAD, while real wage growth lags far behind. The Bank of Canada followed the Fed's playbook, slashing rates to historic lows, fueling asset bubbles, then hiking aggressively to combat inflation, only to face the same dilemma: cut too soon and risk renewed price spirals, hold too long and trigger recession. All this fiat expansion buys time but erodes purchasing power. Japan reached the end game first. After their 1990 asset bubble burst, the Bank of Japan pioneered ultra-low and then negative interest rates, massive bond buying programs, and yield curve control. Public debt ballooned past 250% of GDP, the highest ratio among developed nations. The yen weakened steadily for years. Japanese households, long renowned as the world's most disciplined savers with trillions parked in low-yielding bank accounts, finally began shifting into tangible assets. Gold demand surged in 2024 and 2025. Then silver ignited. Major dealers such as Tanaka Kikinzoku and Japan Post reported unprecedented crowds, waiting lists stretching weeks, and rationing of popular products. Retail premiums exploded to levels equivalent to $128, $135 USD per ounce and higher. The timing could not have been more explosive. Effective January 1st, 2026, just yesterday, China fully implemented new export licensing requirements for strategic dual-use metals, including silver, tungsten, and others. Only a select list of roughly 44 large state-affiliated refineries are now eligible to apply for export permits. Smaller private refineries, scrap processors, and trading houses are effectively barred. Even approved giants operate under renewed directives to prioritize domestic, industrial, and security needs first. China's solar sector alone, producing approximately 80% of global panels, has shifted to newer TOPCon and heterojunction technologies that consume 50 to 80% more silver paste per panel. Domestic mine output runs around 3,500 metric tons annually, yet total consumption exceeds 6,000 tons and is rising fast. There is no meaningful surplus left for export. Beijing's move is textbook resource nationalism, echoing their earlier dominance in rare earths. Overnight, the world's largest silver refiner and consumer has dramatically curtailed excess supply flowing to global markets. Combined with Japan's yen-driven panic and broader Asian industrial demand, physical delivery channels are overwhelmed. Secure transport capacity is limited. Refining bottlenecks prevent quick conversion of large London good delivery bars into retail-sized products. And critically, draining COMEX registered vaults of millions of ounces to ship eastward would quickly reveal how thin immediate eligible stocks truly are, risking delivery failures and forced cash settlements. The latest CFTC commitments of traders reports continue to show commercial traders, primarily the big bullion banks, holding net short positions around 200 million ounces of paper silver. Every sustained $10 upward move generates billions in mark-to-market losses. The rally from 2024 lows near $22 to current levels has already inflicted serious pain. Yet predictions of imminent bank insolvency overlook important realities. Large portions of those shorts serve as hedges against forward purchase agreements with mining companies. A Peruvian or Mexican producer locks in a sale price with J.P. Morgan. The bank neutralizes price risk by shorting equivalent futures. Rising prices hurt the futures side but benefit the minor contracts, often netting close to zero on the hedged volume. Pure speculative exposure certainly exists and is bleeding, forcing margin calls and occasional repo market tightness, but the major institutions possess Tier 1, capital buffers measured in hundreds of billions, with the Federal Reserve as ultimate liquidity backstop. They are wounded and retreating, allowing controlled upward grinding to reduce suppression costs. But systemic collapse remains unlikely absent far more extreme moves. History offers sober reminders. The Hunt brothers believed physical control would force fair repricing. Regulators simply altered exchange rules to break the corner. If silver ever truly threatened broader financial stability, similar interventions, force majeure declarations, trading halts, or cash-only settlements remain available tools. Paper market participants stay vulnerable to rule changes. Owners of physical metal do not. For Americans and Canadians watching retirement savings lose real value, housing become unattainable for the next generation, and government debts compound without end, Japan's premium crisis serves as a vivid preview. When, not if, similar loss of confidence takes hold here. When Social Security or Canada Pension Plan benefits by noticeably less each year, when the next inevitable debt ceiling or budget crisis shakes faith in perpetual borrowing, will local bullion dealers still offer metal at modest markups over spot? Or will we witness the same desperate scramble? The same soaring street premiums in major cities from New York to Toronto to Vancouver? So here are 3 essential takeaways to anchor our understanding going forward. First, paper prices and physical prices can remain decoupled for extended periods when supply chains fracture and trust in fiat erodes. Always distinguish carefully between the infinitely replicable derivative price traded on screens and the finite price of actual deliverable metal. Second, unlimited money creation through central bank balance sheet expansion eventually collides with hard physical constraints. The United States and Canada are traveling the same prolonged debt supercycle that Japan pioneered, only with lower household savings rates and greater political polarization to complicate any resolution. Third, geopolitical resource control is rapidly becoming the decisive factor in commodity pricing. China's deliberate tightening of silver exports is not an isolated policy, but part of a broader strategy to secure strategic materials essential to technology, renewable energy, and national security advantages in a fragmenting world order. The overriding question we cannot ignore: if an 80% premium can materialize and persist in one of the world's largest and most sophisticated economies almost overnight, how rapidly could the same dynamic spread across North America the moment the next major confidence shock arrives? Will the bullion banks successfully manage another prolonged, orderly retreat, or will accumulating physical shortages finally impose the comprehensive repricing that decades of suppression have delayed? We are witnessing monetary history unfold in real time at an accelerating pace. Stay informed and stay prepared. If this detailed exploration helped you connect centuries of monetary evolution to the dramatic signals flashing in markets today, please hit that like button, leave a comment sharing where you believe silver prices and premiums are headed through 2026, and subscribe to Cash Historian for more unflinching examinations of debt mechanics, central bank operations, and the hidden forces quietly reshaping wealth preservation. Turn on notifications because developments in this story are moving quickly. Thank you for spending this time with us, and always remember, in a world increasingly built on layers of paper promises, true understanding and tangible assets remain the most reliable defenses.